Oluwayemisi Sunmola, Sub-Saharan African Banking Research Analyst at Vetiva Capital, joins me now. Great to have you in, Yemisi.
It's great to be here. Thanks for having me.
Yes, it's a pleasure. So, record earnings from these top banks. Analysts are projecting that this is as a result of higher interest rate environment and FX gains. Do you agree, or is there more that we should be looking at with their results?
Yeah, so the banks, like you said, they posted record-breaking profit across board with the likes of Zenith, GTCO, UBA, and First Bank all posting profits well over 600 billion, while, like you said, GTCO and Zenith hit the 1 trillion mark. We also saw solid top-line growth across board, but what we largely saw was the key driver behind this was interest income. Yes, some banks posted some FX gains, but the major driver behind it was the interest income, as well as some income from non-interest, like the fee and commission income. But the strength was largely off the back of the high interest rate environment we saw in the year 2024.
Right, and looking at the current macros, we know, as you have highlighted, what perhaps positioned the banks for such record profits. But we know that the CBN is also positioning to ease monetary, interest rates, and obviously there are also projections. Perhaps we may see a more stable exchange rate, right, naira. So, what are your thoughts? Will the macros continue to favor the banks? How sustainable are these earnings, or was last year an outlier?
Oh, so as at now, the possibility of the banks actually meeting its 2024 budget, given that year on year we are seeing rates are actually higher when compared to what was recorded in the year 2024. Additionally, we've seen the bank raise some capital, the likes of Access as well as Zenith Bank. Have met their minimum capital requirements, and we believe that this would feed into some of their loan book and cause some loan book expansion across board. So we expect to see some resilience across board, although it might not be as strengthened as what we recorded in the year 2024, given the fact that there's an expectation of rate moderation, especially towards the second half of 2025.
So I'm sure we'll have to come to terms with that. But not just record highs in terms of profits, right? But we're talking record highs as well when it comes to dividend payout. GTCO, the highest dividend, 7 naira or so, over 7 naira. So what is your assessment of these declarations, considering the robust profits? Should investors expect even higher dividend payouts this year? Or are banks likely to retain, more capital ahead of the recapitalisation exercise?
So we've seen some of these banks actually meet their minimum capital requirements. So there's an expectation that, especially with the banks, they would either meet their dividend payout, because most of the times we don't see them go back on dividends, or we might not what we do not expect is the higher dividend growth than what was recorded in the year 2024. So we could likely see dividends stay either the same or close slightly higher, given profit expectations.
All right, so we'll get into, after this break, we're going to get into the bank's performance on the NGX as well as service delivery to the customers. Stay with us, it's still Business Edge. All right, you're still watching Business Edge, and we're talking big banks' earnings for 2024. Right now, we're getting into their performance on the NGX as well as their performance towards customers. We have joining us from Vetiva Capital, Oluwayemisi Sunmola, Sub-Saharan African Banking Research Analyst. He's still with us. Thank you for staying with us.
Thank you very much.
All right, so let's get into their performance as a stock, right? Nigerian banking stocks, they performed pretty well in 2024. Most of them posted double digits yearly performance. In fact, we had Fidelity almost run into, triple digits, right? About 90% region when it comes to yearly return. So considering Q1 2025, so far, the performance of the banking index, do you see a stark contrast from last year? Or are there any tailwinds that could spur investor confidence?
So we are still of the expectation that the banks will do pretty well in the year 2024. One, in terms of dividend positioning, although we are not seeing as much traction as we typically see, and this has been as a result of a lot of global macroeconomic headwinds, which we believe that are feeding into the Nigerian market. However, we believe that once the global landscape is quite managed to a specific level, we could see some traction in the NGX, most especially banking stocks. Also, the high yield fixed income market also serves as some sort of negative driver behind the movement of these banking stocks. So, with the likelihood where we would see rates moderate, we would actually see increased investor participation in the equities market and increased positioning in banking stocks, where we would see the banking stocks actually move upwards.
Okay, so for last year, it was recapitalisation that drove that interest, right, in banking stocks. This year, is that the same thing you believe will drive interest in the stocks, or the other tailwinds?
So what largely drove stock movement, one in the year 2024 was the recapitalization. Secondly, significant FX gains also fed into investor sentiments in the banking stocks. What we believe would be the key drivers behind the 2025 movement would be one, dividend positioning, two, future growth potentials by the banks, with the likes of Access Bank currently posting about over 3 trillion in gross earnings, although we saw their profit quite moderate as a result of increased cost of funds. With increased positioning in stocks like that, we also expect that future growth potential by a lot of these big banks would also drive investor positioning in these stocks in the year 2025.
All right, and speaking of the recapitalization, we know the CBN has that new minimum capital requirement. How well positioned are these tier 1 banks to meet this requirement without external fundraising?
We've seen about 2 banks already meet their recapitalization. The likes of Zenith and Access, they've met and exceeded their minimum requirement. So our expectation for the tier 1s, we do not expect that they would require any mergers, or we expect that especially for the tier 1s, a lot of these funds will be sourced locally. However, for the tier 2, there's a likelihood that we could see some mergers occur in the tier 2 banks, but that is quite unlikely. But we will be watching the space to see how the banks expect to navigate these quite uncertain times.
Yeah, uncertain indeed, thanks to what's happening in the US. But in addition to that, we know that banks may be recording record profits and performing by the books, but when it comes to actual service delivery, are they performing? We saw customer transactions and service complaints for some banks go to almost 1 million, right? Last year, banks like GTCO saw upwards of 900,000, and I believe in Q4 they were down on deposits, customer deposits. So, that must take, there must be some level of dissatisfaction on the customer side. So what are your thoughts on this, and what needs to be done as regards this so that the customers also benefit from this good performance as stakeholders somewhat in the banking system?
So, the likelihood of, in terms of customer service delivery, so we've also seen some competition, especially with the likes of fintechs, the likes of OPay and MoneyPoint, also damping some of the increased loan book strength of the banks, also increased fintech adoption by a lot of these players. However, we've seen the banks show some resilience. A lot of them improved their technological platforms. We saw a change in their technologies used. So on the long run, we still expect even the likes of Sterling Bank as recently announced zero transaction costs. We could also see that could lead to an expansion, a loan book expansion for them. So we are actually seeing the banks actually show some resilience, and we would also expect that given their past performance in 2024, they would actually watch to get better in the long run and show some resilience in the year 2025. So barring any other external complications, we expect that they would actually improve their customer service delivery.
All right, we'll see whether or not that happens. We'll be tracking all that and more. But thank you very much for your time.